Have you ever really stopped to wonder why we buy so many things from other countries? I mean, it's a huge question, right? And it has some really powerful answers. Who actually wins from international trade? Who loses? And at the end of the day, is it really worth it? Today, we're going to get into the core ideas behind our global marketplace. And I think by the end, you're going to see it in a whole new light. So let's get into it.
Okay, before we dive deep, just do me a quick favor. Take a look at the tag on your shirt or your jeans. Where was it made? I'm willing to bet it wasn't made in your town, or maybe not even in your country. And that simple fact, that means you are already a key player in the huge, complex world of international trade. See? It's not some abstract theory. It's literally woven into the fabric of our everyday lives.
All right, here's our game plan. First, we're going to imagine a world with no trade at all, just to set a baseline. Then, we'll see what happens the second we open up the borders. We'll pinpoint exactly who the winners and losers are, then explore what happens when governments decide to build tariff walls. And finally, we'll tackle the biggest arguments people make against free trade.
To really get a handle on the impact of trade, we have to start with a before picture. So let's imagine for a second that a country is completely cut off from the global economy. Think of it like a self-sufficient economic island.
So on this island, the price of, well, anything, let's use pineapples in Costa Rica as our example, is decided only by the people buying and selling them right there. The price they naturally land on is what we economists call the domestic equilibrium price. It's a really simple, self-contained little system. Now, to measure how things change, we need a tool. And that tool is called total surplus. Just think of it as the total economic happiness in a market. It's made of two pieces: consumer surplus, which is the great deal you feel like you're getting, and producer surplus, which is the benefit the sellers get. So our whole goal here is to see how trade affects the size of this total economic pie.
Okay, time to open the gates. What happens when our little isolated country decides to start trading with the rest of the world? This, my friends, is where everything gets really interesting. You know, the entire reason trade even works comes down to one incredibly powerful idea: comparative advantage. Now, this doesn't mean being the absolute best at making something. It means you give up the least to make it. That's what we call a lower opportunity cost. Basically, countries start to specialize in what they're most efficient at producing. And the big signal telling them what to do, it's called the world price.
So how does a country know what to do? Export or import? Well, the rule is just beautifully simple. If your price at home is lower than the world price, congratulations, you've got a comparative advantage, and you are going to export. But if the world price is cheaper than your domestic price, then the world has the advantage, and you're going to import. That's really it.
Let's go back to our Costa Rican pineapples. Let's say their local price is $800 a ton, but out on the world market, pineapples are going for $900. Well, since their price is lower, Costa Rican farmers are going to jump at the chance to sell their pineapples for that higher world price. And just like that, they become a pineapple exporter.
So what's the end result of all this? Well, consumers back home might end up paying a little more, but the country's producers gain so much more by selling to the world that the whole country's economic well-being goes up. That little plus D you see there, that represents the net gain. It's like bonus value created for the country just by opening up to trade. The whole economic pie just got bigger.
And that brings us to maybe the most important and definitely the most politically tricky part of trade. Because even though the overall economic pie gets bigger, that doesn't mean everyone automatically gets a bigger slice. There are always very clear winners and very clear losers. So let's look at the flip side. Let's imagine Brazil, where the price for cocoa beans grown at home is $3,000 a ton, but the world price is only $2,500. Well, of course, Brazilian chocolate makers are going to want to buy those cheaper cocoa beans from the world market. So Brazil becomes a cocoa bean importer.
This table just lays it all out so perfectly. In an exporting country like Costa Rica, the producers win and consumers lose a little. In an importing country like Brazil, the consumers win big time with those lower prices, while domestic producers lose out. But, and this is the key, look at that bottom row. In both cases, whether you're exporting or importing, total surplus goes up. The country as a whole is better off.
This right here is the core takeaway from all of this. Yes, trade creates winners and losers, but the economic gains to the winners are bigger than the economic losses to the losers. Now, in a perfect world, this means the winners could just pay back the losers and everyone be better off. But in the real world, that rarely happens. And that's exactly why trade becomes such a hot political issue.
So because there are losers, and because those losers are often a very loud and focused group, like factory owners facing cheap imports, there's always huge political pressure to restrict trade. And the most common weapon in that fight is the tariff.
So what in the world is a tariff? It's really simple. It's just a tax on imported goods. The whole point is to raise the price of stuff from other countries to make your own country's products look more attractive.
Let's just trace the domino effect here. When Brazil puts a tariff on imported cocoa beans, the price for Brazilian consumers goes up. Predictably, they buy less. At the same time, that higher price encourages Brazilian cocoa farmers to produce more, so the gap between what people want to buy and what local farmers can supply gets smaller, which means fewer imports are needed. So the tariff basically creates a new set of winners and losers. The domestic producers, they're now shielded from competition, so they definitely win. The government gets to collect some new tax money, so they win a little bit too. But there is one huge loser, the domestic consumer, who is now stuck paying a higher price for everything.
And this, right here, is the economic punchline. The total loss that consumers feel from that higher price is always greater than the combined gains for the producers and the government. You can see it right on the chart. That bar for consumer losses is way bigger than the bar for the gains. The math just doesn't work out in society's favor.
Economists have a name for this net loss to everybody. We call it deadweight loss. A tariff messes with the market, and it stops deals from happening that would have been good for both the buyer and the seller. People who would have bought at the world price and sellers who would have sold at the world price are suddenly stuck on the sidelines. The tariff literally makes the entire economic pie smaller.
Okay, so if the economics on this seems so clear, why on earth is free trade so controversial? Well, there are several pretty old and powerful arguments for restricting trade, and it's really important we understand the logic behind them.
Here are the big five you'll almost always hear. The jobs argument is probably the most famous one, the idea that cheap imports will destroy local jobs. Then you have the national security argument, which says a country shouldn't rely on others for critical things like steel. You'll also hear about protecting brand new infant industries to help them get on their feet, fighting back against unfair competition from foreign companies, and even using tariffs as a bargaining chip in negotiations.
And you know, these arguments have very real consequences. As this quote points out, when tariffs actually get put into place, the economic theory holds up. That cost doesn't just vanish into thin air. It gets passed on. And usually it's the average person, the consumer, folks like you and me, who end up footing the bill.
So I'll leave you with this final thought to chew on. The unfair competition argument is a really powerful one. If another country's government wants to tax its own people just so they can sell us their stuff for cheap, should we complain? Or should our consumers just say thank you very much and enjoy the discount? As with so much in economics, the answer really depends on who you ask, the producer who's getting hurt or the consumer who's getting a great deal. So who do you think really wins?